so much for tuning in to Talking Point. I'm your host, Neeraj Shah. Over the course of the last 1 month, we've seen a bunch of investment experts come and talk about the possibilities of the pharma index after a very long hiatus starting to show meaningful returns in the current calendar or since we are on 31st March in FY23. I thought it was pertinent to get in somebody who tracks this very closely to talk about what are the nitty-gritties within the pharma pack, what are the points which could actually lead to some traction for the pharma sector, and what within that very wide healthcare bucket could actually show meaningful returns. Where is the case for better returns in the healthcare space for FY23 and beyond? Somebody who tracked this very closely is Chirag Dagli of DSP Mutual Fund. He's the man who is responsible for all pharma investments within that AMC, and he joins in right now to talk about his thoughts out there. Chirag, great having you. Thanks for joining in.
Thank you. Pleasure is all mine. Thank you for having me.
So Chirag, tell us, are you as well in the camp which believes that after a fairly long hiatus for the exporters and mixed performance by some of the other healthcare vertical performers, we might actually see a bit of a secular move in pharma, or is your view different?
No, so we are also positive on the sector as a whole. We think that if you look at the BSE healthcare index and you look at the earnings and you look at the premium versus the broader markets, the discount to the broader market for the BSE healthcare index has never been this low. If you look at the last decade or so, maybe slightly more than that, the average premium of the BSE healthcare index has been about 35%. And where are we currently? We're at about 0%, maybe slightly lower than that. So the discount has never been, it has never traded at this kind of a discount. So from a valuation standpoint, we're very, very comfortable. So that's the first point. The second point is that as far as the whole, as far as the demand environment generally is concerned, we think that COVID provided a slight boost, not just to COVID-related treatment products, but also to a host of other, antibiotic products, etc. That boost has now come off. It is normalized. It's in the base, and we're now back to the usual, early double-digit kind of growth in the Indian market. And as far as the exports are concerned, we've had a bit of a rough patch last few quarters. And we think that now we're at an interesting turning point where new product launches will help, growth and margins for the larger players. So that's in a nutshell, the broad thought that while demand is, fairly stable, we had seen some sort of an issue as far as valuations are concerned. Valuations are also now reasonable, and we think that from here on, earnings growth should be fairly strong.
So Chirag, you're saying that the reason why this valuation gap has narrowed to hitherto unseen levels is because, one, that the valuations have turned demanding, and two, the revenue growth was not as strong, a combination of both. And you think both could actually now turn for the better?
So two things are happening. One is care earnings have been slightly stable, or maybe to an extent, improving as well, given that we had some COVID tailwinds, etc. So a combination of both these is now leading to the valuation gap being very, very large, and it has never been like this in the past, at least more than a decade.
Okay. What within the bucket, because I broadly classify healthcare into three, right? One is the generic exporters, which have been for a while. One is these API players, which have kind of made a segment of their own. And then the healthcare, which is hospitals, diagnostics, etc. And I don't know if there's a fourth bucket, but how do you classify these? And
Sure.
Then what within that 3 or 4 or 5 buckets do you like, and why?
So, the way we think about this is that the formulations business we will break into India formulations and the exports, right? And then there is obviously APIs. Within APIs, there is the custom synthesis guys, and then there's the generic API guys. The custom synthesis are when you sell products to the innovator companies. Generic APIs is when products go off patent and it's an open market. And then you have healthcare services, within which you have hospitals, you have pathology companies, and so on and so forth. If you look at the broader outlook on each of these companies, now let's take them one by one, right? The India formulations market has been one of the most stable markets per se for all our companies. This is a very, very important market as well for our larger companies, because this market gives you the cash flow for you to utilize and grow in the exports market. What has happened in the past, let's say FY21, so for the market as a whole, not for specific company, but for the market as a whole, FY21 saw a bit of a rough patch in terms of volume growth for the industry as a whole. 22, in the first quarter, we saw a big bump up because we had COVID treatments that were available. But remember, better part of FY21, we did not have COVID treatments available. Doctors were basically just trying to repurpose older drugs, etc. What happened in FY20, in the first quarter of FY22, is that we had COVID treatment products, and those took off, and then a host of antibiotic treatments also along with them kind of took off. After that base normalized, we are now back to the early double-digit growth trajectory as far as the Indian market is concerned. And the good thing there is that there will be price hikes starting April 2022 on the NLEM, on the price control drugs, which is about roughly 20% of the market, give or take. Their WPI linked 10.71% price hike is going to help margins for companies and also improve the overall sales outlook. That's as far as the Indian market is concerned. So the prognosis there is that it will go back to double-digit kind of growth. It's a very stable market. There was some bump up in the first quarter, and it is subsequently normalized. Coming to the second bucket, which is the exports part, and the largest exports sort of pot is the US generic market. Now, the US generic market has been in a bit of a downturn starting early FY 15, 16. And since then, it has been on a downturn. Before we entered COVID, prices had come to a level where they couldn't fall a whole lot. Then came COVID, and global supply chains were disturbed. Generic pharma is also one of the businesses which has the most globalized supply chain. Intermediates come from somewhere. You have 20 ingredients. Some come from Europe, some come from China, some come from India, and so on and so forth. So the global supply chains were challenged in COVID. Indians took this challenge head on, and we gained market share. So FY21, as far as the exports market was concerned, was good for the Indian companies, because we were able to supply product that a lot of our competitors in the other markets were not able to. As you know, in the early part of COVID, our pharma companies actually rose up to the occasion, and they were operating really well. Come FY22, what we've seen in the first quarter, maybe early part of the fourth quarter of FY21 as well, is that there was a bit of a high inventory situation in the US, and that led to very sharp price deflation in the US, which is, in our opinion, now broadly stabilized. It's interesting, for a lot of large volume formulation products, the prices in the US, company realized prices, prices at which our companies sell the products in the US. For many large volume products, the prices are very similar to what the realized prices are for the Indian market. So here you have a market which is large, like the US, but it is also a very high OPEX, to run a formulations plant, as per the US FDA guidelines. It's a fairly expensive
Hmm.
kind of a business, and you have prices similar in the US to the India, which to the Indian market, which means that broadly prices cannot dramatically go down from these levels. So that's the second prognosis, and as far as the US generic market is concerned, that prices have, for the base load of products, pretty much come off a whole lot. And from here on, pricing erosion should be, companies should be able to manage with a high single digit, maybe low single digit kind of a price erosion in the US. And on top of that, when you launch new products, you will get growth. So that's the second bucket. US, we're thinking that we are closer to the bottom as far as pricing is concerned.
Yeah. So before we move on to the other buckets, because then people will kind of miss out on the questions,
Yes.
just a couple of follow-backs out there. This phenomenon of the structure of pricing being what it is, it's not new, right? So why is it that the capitalization of that hasn't happened? Also because the way you said that at some point of time there was higher inventory, and at some point of time there's a cyclical downtake, and therefore we haven't really seen a meaningful run for generic exporters the way we probably did between 2010 to 2013, right?
Yes.
We're just not seeing that. And
Sure.
part two of my question is, if indeed the world is opening up, and therefore if India is able to export more, at the same time Indian companies will be subject to that many more FDA inspections, and we haven't really have had a really pleasant history with those as well. Aren't those two things a bit disconcerting? And I would want your view on why is it that despite these factors remaining the same, why has there not been a secular move in the last 8 years?
Sure. So yeah, let me just come to the first part of your question, which is, what happened in FY 10 to 15, that big bull run, right? Where the top Indian companies, the US revenues actually quadrupled over over a 4 or 5 year period. At that time, when we were getting into that into the US market, our market share in the oral solid market was really small, and we took 4 or 5 years to scale up in the oral solids market. Now, within the oral solids market, life is very simple, right? You make one tablet, another one, and so on and so forth. It's a fairly scalable business. Fast forward today, we have the Indian companies. Our market share in the oral solids part of the US generic market is almost 45-50%, right? We started with somewhere closer to 30. Market has gone up, and our market share has also improved substantially. So we are sitting at a very, very large market share as far as the oral solids market is concerned. The other part of the market is the non-oral solids market. The non-oral solids market is essentially your injectables, dermatology products, respiratory products, products where there is a combination of a drug with a device. These are, quote unquote, called complex generic products. This is where the Indian market share is very low, right? And that market share, most of our investments over the last 3 or 4 years for the Indian companies have actually gone in that bucket, in the complex bucket. Depending on companies' capabilities, somebody's targeting injectables, somebody else is targeting respiratory, somebody else dermatology, and so on and so forth. But when you look at this as a pot, this is where our market share is really small, probably in the ballpark of 8 and 10%. And here is where our market share can potentially go up. This is exactly where most of our R&D dollars over the last 5 years have been spent on. So that's the point to make, that we have a small market share in the non-oral solids market. And all the investments are already in, and we are now, as products get launched, our market share will inch up. So that's the second one. But the last point I want to make here is that unlike the oral solids, where you get 10 oral solids and then you can scale it up to 40, 50, 100, so on and so forth. In the complex generic side of things, every product is different. So just because you got one inhaler right in the market doesn't mean you'll get 4 of them right. Ditto for most of the complex generic products. So the rules of the game are slightly different in the complex generic to succeed in the complex generic game. And our companies are learning. Our companies are spending a lot of top dollars around this, And I think we'll see the proof of this over the next couple of years.
Um, so how do I say, have you, through your secondary research and your conversations with companies, realized or found out that there is a higher probability that Indian companies will be able to take the market share? I mean, doing R&D is one thing, but are customers receptive? Are the Indian companies also telling you that yes, the quantum of exports on the non-orals is increasing?
So early signs of success are already there. We've got two companies with respiratory products in the market, and many more will come. But you're right that it's not necessarily a given. Like the oral solids, where it was easier. Here it is, one needs to wait and watch. But there are early signs, whether it is inhalers or it is injectables, dermatology. We are seeing already that Indian companies are launching products, getting approvals. One of the important points you made, Neeraj, is that on the FDA inspections, right? And it's important from a complex generic standpoint. By and large, I think, we have a very large market share. And sure, we've had a fair number of setbacks as far as FDA inspections are concerned. But when you look at it globally, you realize that this is the case with a lot of companies, and we have our own set of challenges. There is no getting away from that. But I think our companies are learning, and to have a 50%, 45-50% participated market share is something, right? When they're participating in the oral solids, we are giving them good quality product at a cheap price. And to that extent, I wouldn't take away from what our companies have been able to achieve. Sure. By and large, I think our companies will, manage the challenges as far as the US FDA inspections, etc.
Okay. I have one quick, before you move on to the next bucket, Chirag, just one quick other thing. In the last 1 month, and although the conflict seems to be at a slightly better footing than what it was, say, 24th of Feb, but we're still in the midst of a conflict, right? And there's a lot of talk about the Russian side saying that the Indian pharma company can replace some of the others. At the same time, there was some article that I read about how the Russian market share in the European region is up for grabs, and Indian companies might also be able to grab that. Now, I mean, you would understand this space really well. Do you sense an opportunity for India both in the Russian space as well as in the European space? Why or why not?
Sure. So 2 points I want to make. First is that Russia imports more than 70-80% of their medicines that they consume, right? Which means that there is no choice but to import. And if the Europeans do not supply for whatever reason, if the US does not supply for whatever reason, the other large block of suppliers available is only India, right? So you don't find many formulators in China, for example, or sure, you will have a few companies here and there, but a large block is going to be India. So clearly, if the European nations or US stop supplying medicines to Russia, India can rise up as far as the generic market is concerned, where we have the technology, we have the capacities to supply. So that opportunity is certainly there. As far as the opportunity of Russian supply in the European markets is concerned, I don't think it is a very large opportunity. I think Indians will gain market share, but not because of this. Not because of the Indians will gain market share simply because we have the scale in the export space. See, our Indian companies supply. We are the pharmacy of the world, right? So we supply to the US, to European countries, to the rest of the world markets, poor African countries, all of these from our factories here. That kind of scale, that kind of benefit of scale is something that it will take a while for others to kind of get. Just imagine that you're supplying from one factory. There's a pharma company, they have probably 60-70% market share, right? They make their own API. They supply that same formulation to so many countries. That kind of scale, that kind of backward integration, it's very, very
It's
tough
very
to
yeah.
beat.
Yeah, I mean, in many ways, it is a very, very competitive industry that India has managed to kind of
It is.
create, and which is not easily replaceable. So therefore, I'm not asking you to name companies, but I'm just for clarity for the viewers. What you're saying is that the pricing and the demand environment and market share in non-orals for various companies, it could be a Sun Pharma, Lupin, Dr. Reddy's, Cipla, what have you. So that bucket of companies could actually see growth because of these factors, right?
Yes. Yes.
Okay, perfect. Now, yeah, we have about 6-7 minutes still left of the interaction, and therefore I would urge you. I mean, I'm requesting you to move on to some of the other buckets as well. What else within that vertical do you believe healthcare do you think is poised for growth?
We think, see, I think there will be growth in both the hospitals as well as the pathology companies as well. There will be growth in APIs as well. Let me spend a minute each on each of these. In APIs, what is going on, right? In APIs, whatever is relevant for the specialty chemicals industry, right? China plus one, outside of India, what other chemical manufacturing clusters are there? There's China, there's Europe some bit, there is US some bit, and then there's India. If China, which has a very large market share, is trying to move away, then there aren't capacities that are coming up in the developed world. So which means that APIs. So India is the only place where we get to take that market share. So in APIs, I think that China plus one factor, plus the fact that Indian government wants to reduce dependence on China, etc. So India imports about $2.5 billion worth of APIs and intermediates from China. That opportunity is up for grabs, right? And over time, we want to keep going back. It's not that Indians don't have the technology or the capability to make these products. It's just that China was available, it was cheap, and hence India was, just sourcing from there. So that opportunity for API companies is there. My sense is that even for APIs, early double-digit kind of volume growth is not something which is unreasonable to expect from the API companies. Now, valuation froth on the API companies, a lot of it has normalized. A lot of prices went up through COVID period for APIs, and they are now subsequently back for the generic APIs. And that, I think, we're now broadly at that stable kind of environment. Sure, input prices have gone through the roof, but I think that two things will happen. One is that the input prices will come off some bit, and API prices might go up some bit. Net, I think API companies should be able to manage well. In the second bucket of hospitals, I think COVID has benefited on the COVID business, but the non-COVID business has also taken a big beating. We think that business will come back. There's a lot of pent-up demand. People haven't stopped getting sick. It's just that they've stopped going to hospitals, right, for operations. And 60% of surgeries are elective surgeries, where the patient can decide that I don't want to get this done today. Let me get it done day after, or maybe next month, and so on and so forth. So that kind of push out has happened. It will come back. Interestingly, in hospitals case, most of the capex that we are now seeing is all brownfield capex, right? I have a 500-bed hospital. I'm going to add 100 beds on that. The capital efficiency on that brownfield expansion is just very, very good. So return ratios will remain very elevated for hospital companies, and we think they're on a very good wicket. This pent-up demand should be able to again garner reasonable volumes for hospital companies as well. Coming back to the last part, which is your pathology companies. In pathology, again, like hospitals, there was a boost to the COVID business, but the non-COVID business came off. We're now already seeing, on a 2-year CAGR basis, so just comparing pre-COVID versus now, we're already seeing the non-COVID business for diagnostic companies in the high single digits kind of a number. So to that extent, on a 2-year CAGR basis. So we are seeing recovery in that business is what I'm trying to say. And I think it will come back with a big bang. Valuations for a lot of pathology companies have come off, and they've corrected. And it is an interesting space, I would say. Valuations had held us back in the past. Capital efficiency is very, very good in this business. There's just one point I want to make on the diagnostic companies is that markets believe that there's a lot of opportunity to do M&A. I think M&A is a overrated opportunity in diagnostics. There just aren't any cheap assets available for companies to buy.
So you reckon that because I heard you use the term interesting, which could denote any which could be taken either ways. But my question largely would be that you would reckon that the organic growth rate for diagnostics will be the growth rate for these companies. The inorganic ones, if they are taken to spur growth, might turn out to be very expensive. I mean, we had one very interesting M&A in this and that company is due to become public soon. But aside of that, you reckon these things will now start becoming narrower and narrower?
Yes.
Okay. And just to fall back, Chirag, I mean, follow up there very quickly, because I mean, a lot of people wonder that if the growth rate of the company was so good. I've had other experts come in, somebody who's worked with you in the past in DSP come in and say that these companies are so good because they are trading at organized is about 15-20% market share. They are weaning away market share. They don't need advertisements. They don't need capital. And yet we've had these companies crack nearly 30% or 33% from their highs. If everything was so good, why such a steep correction?
So I think valuations, the starting point of valuations, they were expensive, and there was a belief in the market that these companies will keep gaining market share, keep acquiring the smaller organized chains. But that is not. Look, in the past, this has happened. 5 years back, 6 years back, this has happened. Companies were bought out at lower multiples and then turned around and then so on and so forth. Right now, what is happening is that every seller is able to see 5 companies trading at very large multiples, right? So deals in the past have happened at between 12 and 15 times EV EBITDA. Now deals are happening at 7, 8 times sales, X of COVID sales. So that kind of when you acquire something at that kind of a multiple, very, very tough to get a reasonable return on capital on such a business, right? So I think that is what diagnostic companies are today reflecting, that there just isn't opportunity for you to acquire cheaper assets cheaper and gain market share, which means you're pretty much back to an organic growth kind of a number, and that in the early double-digit kind of a thing will continue. So that is what diagnostic companies are the valuations are kind of reflecting.
So if I can ask you, a combination of valuation, growth, and return ratios on these 3 parameters, if you were to look at hospitals currently versus diagnostic chains currently, because a lot of people believe they're kind of amphibious, so to say, what do you like more?
So I think hospitals we would prefer, simply because the hospital business is far less, it's far more difficult to disrupt. Diagnostics is very, very easy to disrupt. There's online that's happening. Pharma companies are starting their own diagnostic companies and so on and so forth. So it's very easy to disrupt. And when you're talking about capital efficiency of 100%, maybe 50%, what are you saying? Effectively, you're saying that my capital will come back in 2 years, in less than 2 years, right? So and you think about it, you look at the balance sheets of some of the larger pathology companies. The capital required for that kind of scale is just not a whole lot, right? It's time, but some of these companies can be deep pocketed. Some of the disruptors can be deep pocketed. So I think from a pure disruption standpoint, we prefer hospitals over the diagnostic companies, pathology companies. Plus, of course, the valuations.
Yeah, of course. Get your point. I think your entire conversation brings me to the belief that your thought process, the principal starting point comes from valuations, and then you look at a lot of other factors and then take your call. So it'll be interesting to see. I presume that's how you are approaching this space.
So I want to look at businesses first rather than valuations, but I also don't want to overpay a whole lot. See, a lot of times our stocks do well on narratives, and I think I want to try and make sense of whether the narrative is really backed by numbers. If it isn't, then I think we don't want to participate in those options. So that's the broad understanding that first, what is the first port of call is that is it a good business? If it's not a good business, then we I don't want to simplify the definition of a good business with just one number or two numbers that it has to have at least this much return on capital in the last 2 years or 1 year or 3 years or 10 years. That's not it. You want to fundamentally look at the business, whether it is a good business or not, and then try and everything else is after that. And then you of course try and not overpay. That's the very simple.
Keep buffer. What lovely,
Yeah.
lovely conversation, Chirag. It was lovely talking to you. It's the first time that we have had you on BQ, and
Yes.
look forward to having you more often.
Pleasure is all mine, Neeraj. Thank you so much for having me.
Now, thank you for being here. Viewers, thanks for tuning into this edition of The Talking Points.